Welcome. The purpose of this presentation is to provide a general platform overview of IBM Planning Analytics. The presentation is provided by Application Consulting Group, a premier IBM business partner, solution provider and integrator, and specialist in corporate financial performance management. This is a demonstration of integrated financial statements within IBM Planning Analytics. The financials in this video are simplified for demonstration purposes. The model will also work with a much more built-up set of financial statements. First, on the financial reporting sheet, we have a sample balance sheet and income statement. The balance sheet shows a balance of $1,000 in cash offset by $1,000 in stockholders' equity. There are no other transactions in the system at this point. Let's demonstrate the flow of revenue and profit from the income statement into the balance sheet and accounts receivables. Let's say there's $100 in revenue in the month of January. This results in $100 in gross profit and $100 in net income. Now we see the 100 reflected in trade receivables in the balance sheet for January, offset by $100 added to retain earnings because of what's in net income. The system is currently set up to assume that accounts receivable will turn over to cash in 30 days. So in February, the $100 is added to cash and it's zero in accounts receivables. If we want to change the amount of time it takes to collect accounts receivable, you can go into the input sheet. In the middle table, there are P&L assumptions that you as the user can set up for different accounts. This is currently set up so that 100% of accounts receivables is collected within the first month after sale. I can change this on the fly to be, for example, 50, 30, 20% to spread this out a little more and account for later credit payments. Now, when I go back to the financial reporting sheet, we start with $100 in accounts receivables. $50 is collected in the first month as we specified, leaving me with $50, and then another $30 is collected in the next month, leaving $20 left in accounts receivable in March. When I continue booking additional sales, say for February and for March, the accounts receivable grows from 100 to 150 to 170 as sales continue and the collection happens with a 50, 30, 20% split. You can get more detail into this by clicking into the AR waterfall and seeing the collection by month as the sales occur during the year. This second example is going to show an insurance prepayment. We can record this in the input sheet. The transaction input table right here allows for input of individual purchases and assumptions. So let's say I'm going to prepay $120 in insurance premium for the month of January. I can specify that this is an insurance expense in the comments section. And let's say I want the term to start in February. Now I want to define the amortization period for this payment. The P&L assumptions table down here shows preset and custom amortization schedules that I can follow. For this prepayment, let's choose from the drop-down the 12-month straight allocation schedule, and I can pick whichever one I want from this drop-down. Starting in February 2019, you can see the resulting insurance expense of $10 per month. When I go back to the financial statements, first I can see that the P&L is being hit by that $10 insurance expense starting in the month of February. Second, in the balance sheet, I can see that in January 2019, there is a prepayment of $120 offset by $120 credit to liability to creditors. So I'm assuming that this is not paid in cash. There will likely be an invoice and I will pay that invoice off over time. So in February, the trade payable will zero out and will be offset by a decrease in cash to reflect this payment. So now the cash will be $880. In the month of February, the prepayment amount is going to go down to $110, and retained earnings is going to go down by $10 as well because I have an insurance expense of $10 in the P&L. This next example will showcase recording the purchase of an asset. So in the transaction input table, we are going to put $240 as the amount purchased for the fixed asset. And let's say we bought it in January, and we'll start using it in February 2019. This is when I want the depreciation term to start, in February. We can also specify the amortization schedule we want through this dropdown, which was shown also in the last example. For this purchase, let's use a custom amortization schedule, which, specified in the P&L assumptions table, has a 50-30-20% split. If I want to isolate the effects of the transactions from this sheet in the P&L statement over time, I change the table at the bottom here, titled Detailed Accounts and Transactions, to show the depreciation expense. It's currently set to insurance expense, which we saw before. I can now see that the $240 is being depreciated starting in February 2019, which is when we specified the asset is being used. Going back to the financials, I can see that depreciation expense reflected on the income statement in the depreciation line, resulting in negative earnings. On the balance sheet, I see a $240 asset being added because of that purchase in January, offset by a $240 liability to other current creditors. Other than that, nothing else has changed, so assets are now $1,240 and liabilities and equity are $1,240 as well. Because of depreciation, that asset balance will go from $240 to $120 to $48, offset by the $120 and $72 installments for amortization that are also hitting retained earnings and net income. Furthermore, I pay the $240 in February, so the accounts payable is going to net out to zero and the cash balance will go from $1,000 to $760 because of that payment. So far we have looked at 3 specific examples. If we put it all together, we can change many things all at once and see the effects. Let's say we have $100 in revenue in the first 3 months of 2019, so in January, February, and March. And let's add some transactions by going into the input sheet. Now, before I do that though, let's spread out the working capital allocation a little more. So instead of collecting everything in month 1, let's do 50, 30, and 20%, just to make it a little more realistic. All right, so let's add $120 in insurance prepayments and a fixed asset purchase of $160. We now have these 3 purchases using these 3 amortization methods. And you can see that because I have 2 assets being depreciated, these individual transactions are reflected here in the depreciation schedule at the bottom of the page. And I can also see how it's hitting the P&L. Now in the financial statements, if I go back to my financial reporting sheet, I see a full P&L that will have $100 in profit in the month of January and then negative earnings after that because of all the depreciation expense. There's also the balance sheet where I see there are receivables that are being driven by revenue minus collections. I also have fixed assets reflected on the balance sheet and a prepayment balance which is getting amortized. I'm putting all of these purchases into one payables account, and then I'm depreciating that payable account based on the same methodology as how I'm allocating accounts receivables. I can choose a different method for this, but for simplicity and the purposes of this demonstration, I did it this way. You can see that the balance sheet balances and all the transactions are being reflected. Furthermore, if I want to look at the walk forward and the reconciliation, I can see it in the reconciliation sheet up here. This shows step by step the opening balance, additions, write-offs, and ending balance for each month. So the system provides a full transparency to the changes to the balance sheet every month by showing any additions and write-offs. As you can see, my cash balance at the end of March is $714, which is the same as what we saw in the financial statements, and I have full transparency of how I reached that number. As you can see by the examples in this video, everything in the system is real-time and integrated and connected. If you make a change in one account, it flows through the financial statements according to pre-programmed logic applied to the system. This makes accounting for changes involved in forecasting and budgeting simple and convenient. This was a simple example, but you can also forecast and budget for balance sheet accounts as well. And so this concludes our general overview of IBM Planning Analytics. If you have any questions you would like to discuss further, please contact us at info@acgi.com or call the number provided. Thanks for watching.